Hello, Marc Ostwald from ADM Investor Services International with something of a little bit of a review of what's happened this year and what it might imply for things next year. So my very first chart is about bond yields, government bond yields. As one can see, we've had a very sharp rally, above all in US Treasuries this time of year, a little bit more than this time a year ago. We were at 3% and we rallied down all the way down to 145. And in 10-year bond terms, we were at almost at 0.5% this time last year, and we've been as low as minus 0.75. Now, we have had some sort of a correction in the meantime, but the idea that we would repeat such a strong rally in government bond yields seems very, very unlikely. It's made all the more unlikely given how tight credit spreads are, which is basically what is my next chart is about. I've specifically picked out two sets, both of them about high yield. The white line on that chart is the US dollar Asia high yield index, credit spread index, and the yellow one is the US all sector high yield spread. As one can see, we've had a relatively choppy year on that front, a lot choppier than one might think, given what's been going on in equity markets. But coming in at the year end, we have seen a very, very sharp tightening here. The whys and wherefores of what has done better than where else, but is not probably the key issue here. The key issue is what we are is in an environment where we are starting to see, above all in Asia, above all in China, and to a certain extent in India, a rise in credit in defaults. And that should not really be commensurate with a sharp tightening, the sort of sharp tightening in credit spreads that we've seen. And that is something to watch out for very much next year, that it probably won't be as benign an environment, even if the low level of government bond yields will always have people looking for opportunities on any spread widening. The third, or the next pair of charts, the last two pairs of charts, are about volatility. This has been a historic year in many senses for the fact that we don't really have had only a couple of major spikes in volatility, and even then it's not been that significant. The green line on this chart is the US Treasury market volatility. As we can see, when the Fed basically started to signal that it was probably done with easing, so we started to have a narrowing in Treasury volatility, and the VIX volatility index on the S&P 500 has been very, very subdued, other than very, very minor spikes. Whether that's likely to persist next year seems unlikely, particularly if we get an environment where we do have some widening in credit spreads, say a rise in credit defaults on credits. And that will also have some impact on Treasury volatility, in the sense that people will probably at that moment also be looking at opportunities to go up the credit curve into Treasuries. So even though there isn't that much scope. The other feature of this year, I think, which has been notable, is the final chart that I have for today, which is FX volatility. As one can see, we are pretty much at the lows for the year. In fact, we'd probably be a lot lower if it hadn't been for the volatility that we've seen both immediately post and in the week after the UK general election, the pound basically being the only currency showing any signs of life. That FX volatility in a less stable environment for yields will probably start to increase. So a less becalmed year next year, and I think the big concern will be actually what happens with the US-EU trade next year. And that's the thoughts for the year. I wish you all a very happy new year.